On the island of Borneo, in the river-cut highlands of East Kalimantan, drill core came out of the ground in long cylinders of rock. The cylinders were split lengthwise, sealed in plastic bags and trucked along a road to the assay laboratory at Balikpapan on the coast. Somewhere along that road, or in the camp before the bags were sealed, gold was added to the crushed rock. Panned river gold, and, the evidence later indicated, gold filed from jewellery, was worked into the sample particle by particle, until the laboratory reported grades of gold that did not exist anywhere in the deposit. No standard duplicate samples were pulled. No umpire laboratory independently re-drilled the holes to confirm the results. For 4 years, the assay numbers from those tampered bags drove the valuation of a company on the Toronto Stock Exchange from pennies to a market capitalization the record places in the billions of dollars. The structural question this episode answers is narrow and precise. How does a mineral resource estimate, the single most heavily relied upon number in mining finance, get built entirely out of falsified physical samples? And why did the verification chain that was supposed to catch it never close? To understand how Bre-X worked, you first have to understand what a mineral resource estimate is and what it is supposed to do. When a mining company says a deposit contains a certain number of ounces of gold, that number is not measured. It is inferred. No one digs up the entire ore body and weighs the gold. Instead, the company drills holes into the ground, extracts cylindrical cores of rock, and tests samples from those cores for gold content. The result of each test is a grade, expressed in grams of gold per ton of rock. The geologist then takes the grades from many holes spaced across the deposit and uses geostatistical methods to interpolate the grade of all the rock in between. Multiply estimated grade by estimated tonnage, and you have an ounce count. This is the entire epistemological foundation of mining valuation. The ounces in the ground are a statistical construction built on top of physical samples. If the samples are honest, the construction can be sound. If the samples are corrupted, every number downstream of them is corrupted, and there is no way to detect the corruption from the numbers alone. The grades will look internally consistent. The geostatistics will model cleanly. The resource estimate will pass every mathematical test you can run on it, because the mathematics is operating faithfully on poisoned inputs. The industry knew this vulnerability existed. That is why a set of sampling protocols had developed over decades, designed specifically to protect the integrity of the physical chain between the drill hole and the assay number. These protocols are the load-bearing structure of the entire system. There are essentially 4 of them. First, chain of custody. The core, from the moment it comes out of the ground, must be controlled, logged, and secured so that no material can be added or substituted before it reaches the lab. Second, duplicate and split sampling. The core is split in half. One half is sent for assay. The other half, the reference half, is retained, sealed, in case the result needs to be independently verified later. A portion of samples is also split into duplicates and submitted blind so the lab's consistency can be checked. Third, standards and blanks. Known reference samples of certified grade and known barren samples containing no gold are inserted into the sample stream without the lab knowing which is which. If the lab reports gold in a blank or the wrong grade in a standard, the assay process is flagged. Fourth, umpire or check assays. Samples are sent to a second independent laboratory. If two labs disagree systematically, that is a signal something is wrong in the chain. These 4 protocols exist to defeat exactly one failure mode: someone tampering with the samples. Each one is a verification gate. And at Busang, according to the record assembled in the aftermath, all 4 were either absent or compromised. There was no proper chain of custody on the road to Balikpapan. The core was crushed in its entirety rather than split and retained, which meant no reference half existed to retest. Standards and blanks were not used in a way that would catch salting. And the check assays, when they finally came too late and from the wrong material. Fars, here is the structural feature that made Busang uniquely catastrophic, and it is worth stating plainly. At many deposits, the original core is preserved. If fraud is suspected, you go back to the reference samples and reassay them. At Busang, the entire core was crushed and consumed in the assay process. There was nothing to go back to. The physical evidence of the real barren rock was systematically destroyed in the act of testing the salted rock. Whether that practice was justified by geology or designed to eliminate the paper trail is a question the public record addresses, and we will return to it. But structurally, the consequence is clear. The only surviving record of what Busang contained was the assay numbers themselves, and the assay numbers were false. So the mechanism, at its core, is not financial engineering. It is physical. It is the insertion of foreign gold into a sample stream, protected by the destruction of the verification material that would have exposed it. Everything else, the stock price, the takeover interest, the analyst coverage, was a superstructure built on the single physical act repeated across hundreds of holes. Now, the architecture. How was this deployed, and how did it scale from a small exploration company into one of the largest gold stories in market history? Bre-X Minerals was a Canadian exploration company. In the early 1990s, it acquired an interest in the Busang property in East Kalimantan, Indonesia. Exploration companies of this type are, in financial terms, options on discovery. They have no revenue. Their entire value is the market's estimate of what might be in the ground multiplied by the probability that it is really there. When drilling results come in positive, the value can move by orders of magnitude on a single press release. This is the structural environment in which salting becomes most powerful, because the company's value responds directly and immediately to assay numbers, and assay numbers are precisely what was being falsified. The deployment proceeded in stages. Step 1. The initial results. Drilling at Busang began returning gold grades. Those grades were reported to the market. The early holes established the premise that Busang was mineralized, that there was gold in the system. The record indicates the grades reported were not what the rock contained, but the market had no way to know that. The stock began to rise. Step 2. The expansion of the estimate. As more holes were drilled and more salted samples were assayed, the company's geologists revised the resource estimate upward repeatedly. The number of ounces claimed to be in the ground grew through a series of announcements. It went from millions of ounces to tens of millions, and ultimately the company's public statements described a deposit that would have ranked among the largest gold discoveries ever recorded. Each revision was supported by assay data, and each assay number traced back to the tampered sample stream. Step 3. The consultant validation. This is structurally critical. Bre-X retained an independent mining consultancy to prepare resource estimates based on the drilling data. The the consultancy did what consultancies do. It took the assay results, applied geostatistical methods, and produced an independent-seeming resource calculation. But the consultancy was calculating on the same poisoned inputs. The independence was real at the level of the mathematics and entirely illusory at the level of the underlying samples. The consultant did not re-drill the holes. The consultant did not have independent core to test. The consultant modelled the numbers it was given. And because those numbers were internally consistent, the model produced a clean, professional, large resource estimate that carried the consultancy's name and reputation into the market. This is the mechanism by which assaulting fraud acquires credibility. The fraud is in the physical samples. The validation layers sit above the samples and never reach down to them. Each layer validates the layer below it. The consultant validates the assays, the analysts validate the consultant, the stock price validates the analysts, and at no point does any layer go back to the rock. Step 4. The scaling of market value. As the resource estimate grew, the stock did what the structure dictated it must. Bre-X moved from a minor listing to a widely held company. It was added to a major index. Institutional money came in. Mutual funds held it. Pension exposure flowed in through index participation. The record establishes that a great deal of capital, including capital managed on behalf of ordinary investors who had never heard of Busang, was now riding on assay numbers from samples salted on a road in Borneo. Step 5. The strategic competition. A deposit of the claimed size attracted the major gold producers and, the record shows, the interest of the Indonesian government in the structure of the eventual mining rights. The deposit became the object of a contest over who would develop it. This is significant structurally because it brought in a counterparty with both the capability and the incentive to perform genuine, independent due diligence. A major producer that intends to actually mine a deposit cannot rely on the promoter's assay numbers. It has to confirm them itself. And confirming them itself meant doing the one thing no one had yet done: drilling its own holes into the same ground, under its own chain of custody. Before we get to that confirmation, hold the architecture in view, because the org chart is simple, and that simplicity is the point. At the bottom, the salted samples. Above them, the assay lab, reporting grades faithfully on corrupted material. Above that, the company's own geological team building resource estimates. Above that, the independent consultant modelling the same numbers. Above that, the analysts and the index and the institutional holders. And at the very top, the share price, a single number that compressed all of it into a market quotation updated by the second. Every arrow in that chart points upward. Information flowed from the samples to the market. What never happened until the very end was an arrow pointing back down from the market's confidence to a fresh, independent test of the rock. The verification chain was, in its design, a one-way structure. And a one-way verification structure is not a verification structure at all. It is an amplifier. This brings us to the detection failure and the question that the case forces. Why did the gatekeepers not catch it? And what would have had to be true for them to catch it sooner? Begin with the assay laboratory. A lab is not designed to detect salting. A lab measures the gold in the sample it is given. If you hand it a sample containing added gold, it will faithfully report a high grade. The lab is, in the chain, the most reliable component and simultaneously the most useless against this fraud. because its reliability is precisely what carried the false numbers forward with credibility. A faithful lab reporting on a corrupted sample produces a corrupted result that bears the lab's stamp of reliability. There was, the record indicates, a detectable signature in the gold itself. The gold reported from Busang had characteristics consistent with alluvial gold, river-worn gold, rather than the gold you would expect from the hard rock geological setting being claimed. That is a clue that a metallurgist examining the physical gold could have flagged. But the standard assay process does not examine the morphology of the gold particles. It dissolves them and measures the quantity. The signature was present in the physical material and invisible to the test being run. Now, the independent consultant. The consultant's role was to produce a resource estimate, and a resource estimate is a calculation on data. The consultant's professional standards governed how the calculation was performed, not whether the underlying samples were genuine. The structural assumption embedded in the entire resource estimation discipline at that time was that the sample data was honest, because the sampling protocols were assumed to be in place. The consultant was operating inside a framework that took chain of custody as a given. When the chain of custody is the thing that has failed, a consultant working downstream of it cannot detect the failure from the numbers. The numbers will look fine. They did look fine. Now, the analysts. Securities analysts covering Bre-X were modelling the value of a discovery using the company's reported resource figures. Some analysts visited the site. But a site visit is not a re-drill. You can stand on the ground in Borneo, watch core come out of a hole, and learn nothing about whether the bags were tampered with on the road to the lab. The analysts were structurally positioned even further from the physical samples than the consultant was. They were validating the consultant's numbers, and the consultant was validating the assays, and the assays were faithful reports on salted rock. Each layer's diligence was real, and each layer's diligence was confined to its own layer. Now, the auditors and the exchange. Bre-X was an exploration company. Its financial statements reported its expenditures and its capital. An audit of those financial statements does not verify the gold in the ground. There is no line item on a balance sheet that says ounces confirmed. The resource was an off-financial statement asset, disclosed in technical reports, not booked at the inflated value. The financial audit had nothing to grab onto. The exchange listing requirements governed disclosure, not the physical truth of geology. The entire apparatus of financial gatekeeping was pointed at the wrong layer of the structure. The fraud was not in the books. It was in the bags. So what would have had to be true for earlier detection? 3 things, and each one corresponds to a missing protocol. First, an intact chain of custody with retained reference splits. If half of every core had been preserved and sealed, an independent party could have reassayed the reference material and compared it to the reported grades. The discrepancy would have surfaced, but the core was crushed entirely. The reference material did not exist. This is the single most important structural fact in the entire case. The destruction of the core was not a footnote. It was the load-bearing element that made the fraud undetectable by the normal method, going back to the original sample. Second, blind insertion of certified standards and blanks at a rate sufficient to catch tampering, controlled by a party independent of the people handling the core. Properly run, this would have produced anomalies. The record indicates the controls that existed were inadequate to this purpose. Third, early umpire assays at a fully independent laboratory using independently controlled splits. Not the company's samples sent to a second lab, which would have carried the salting along, but independently collected material. This is, in effect, what finally broke the case, and it came years too late. The unifying observation across all three: every one of the missing safeguards was a control over the physical sample, and every gatekeeper who could have caught the fraud through analysis of the numbers was structurally downstream of the physical sample and therefore powerless against tampering at the source. The verification chain failed because it was built to verify calculations, and the fraud lived below the level at which any calculation begins. Now the unraveling. The sequence is precise and it pivots on one event. An outside party finally drilled its own holes. The contest to develop Busang had brought in a major mining company as a partner in the project structure. That company, preparing to commit to development, undertook its own due diligence drilling. This is the arrow finally pointing back down. For the first time, holes were drilled into the Busang ground under a chain of custody controlled by someone other than the original team, with samples that had not passed through the original handling process. The results came back barren. Insignificant gold. Not a reduced estimate, not a disappointing grade. Nothing of economic consequence where tens of millions of ounces had been claimed. The discrepancy was not a matter of statistical revision. It was categorical. The independent holes found essentially no gold in ground that the company's holes had reported as among the richest ever drilled. There is no geological model that reconciles those two outcomes. Gold does not exist in one set of holes and vanish from immediately adjacent holes. The only structure that produces this pattern is that one set of samples was real and the other was not. The sequence then accelerated. The independent partner's findings created pressure for an explanation. An independent review and an investigation into the sampling were undertaken. The investigation reached the conclusion the geometry of the results already demanded. The samples had been tampered with. The phrase used in the reporting around the investigation, that the results were consistent with the gold having been added to the samples, is the technical description of salting. When that conclusion became public, the structure collapsed in the only way a one-way verification structure can collapse, all at once. The entire valuation of Bre-X rested on the assay numbers. The assay numbers rested on the samples. When the samples were established to be salted, every layer above them lost its foundation simultaneously. The resource estimate was worthless because it was a calculation on false data. The consultant's report was worthless for the same reason. The analyst models were worthless. The share price, which had compressed all of that into a single number, went to essentially zero. The market capitalization that the record places in the billions evaporated, because there had never been anything underneath it except the salted bags. The aftermath spread across multiple jurisdictions, and the structural lesson is in how the enforcement and civil machinery responded to a fraud whose central act was physical rather than financial. In the United States, the securities enforcement apparatus addressed the matter through its authority over securities that had traded in US markets and been held by US investors. The structural basis for that jurisdiction is straightforward. The falsified resource estimates were disclosures that reached the market, and investors transacted on the basis of those disclosures. When the disclosures are built on tampered samples, they are materially false statements regardless of where the tampering physically occurred. The harm to investors is the same whether the lie is in a balance sheet in New York or in a sample bag in Borneo. This is the structural through line that connects Bre-X to every other case in this series, despite its unusual mechanism. Most of the frauds we examine live in the numbers, in the accounting treatment, in the financial instrument. Bre-X lived below the numbers, in the physical inputs that the numbers describe. But the legal and economic consequence is identical, because securities markets do not trade in rock. They trade in representations about rock. And a false representation is false whether it was manufactured through an accounting entry or through a particle of jewelry gold shaken into crushed core. The disclosure regime regulates the representation. The salting corrupted the representation at its source. The enforcement followed the representation, not the rock. There is a further structural observation in how the collapse distributed its losses, and it returns us to the index and the institutional holders. Because Bre-X had been added to a major index and held broadly, the losses were not confined to speculators who had made a deliberate bet on a risky exploration story. They reached passive holders, index participants, and ordinary savers whose exposure came through diversified vehicles. This is a recurring structural feature of frauds that achieve large market capitalizations. At small size, a fraud's victims are the people who chose to take the risk. At index scale, the victims include people who never made a choice about the specific company at all. The mechanism that converts a promotional exploration stock into a broadly held index constituent is the same mechanism that converts a contained fraud into a distributed one. Inclusion criteria based on market capitalization and liquidity will admit a fraudulently inflated company precisely because the fraud has inflated it. The index is, in this respect, another one-way amplifier. It responds to the share price. It does not interrogate what the share price is built on. What does this case establish about the mechanism as a matter of structure rather than as a verdict on anyone's character? It establishes that the integrity of the entire mining valuation system rests on a physical chain of custody that sits below every financial control, every audit, and every disclosure rule. None of the financial gatekeepers can verify the rock. They can only verify the representations about the rock. The one control that matters against salting is physical. Retained reference samples, independently controlled, that allow the original material to be retested. When that control is absent, when the core is consumed in the assay and nothing is retained, the fraud becomes undetectable by every downstream method, and the entire superstructure of consultants and analysts and indices becomes an apparatus for amplifying a falsehood it has no means to examine. The direct structural consequence of Bre-X was a reform of the very protocols whose absence enabled it. In Canada, where Bre-X was listed, the regulatory response produced a standardized framework for the disclosure of mineral projects. That framework, formalized as National Instrument 43101, requires that technical disclosures be prepared and verified by a qualified person, with specified standards for sampling, quality assurance, quality control, chain of custody, and the verification of data, including independent verification by the person taking responsibility for the disclosure. The reform did exactly what the structural analysis predicts it must. It pushed the verification requirement down to the physical sample, the layer where Bre-X's fraud lived, and where every prior control had failed to reach. It required the insertion of standards and blanks, the use of check assays, the documentation of custody. It made the one-way amplifier into something closer to a chain with a verification step at the bottom. The finding then is this: Bre-X was not a failure of financial controls, because the financial controls were never pointed at the place where the fraud occurred. It was a failure of physical sample integrity, exploited by the destruction of the reference material that would have exposed it, and amplified through a verification chain whose every layer validated the layer below without ever reaching the rock. The resource estimate, the most relied upon number in mining finance, was revealed to be only as honest as the bags of crushed core on a road in Borneo. When an independent party finally drilled its own holes, the ground gave its answer, and the answer was that there had never been anything there at all. The record closes on that finding. The mechanism is sufficient.